All right, let's actually stay with the banking space and wrap our heads around what exactly was announced with respect to these LCR guidelines yesterday. And it is a big relief for banks. The RBI has eased the liquidity coverage ratio norms, giving banks more flexibility in managing their funds. And the implementation of these new norms has also been now pushed. I mean, some are fearing that it could happen from this year itself, but it's happening from the 1st of April 2026. Pranav Gundlapalle, Senior Analyst, India Financials at Bernstein, is with us to make sense of this development and, of course, overall this big run that we're seeing in financial stocks. Pranav, great to have you on. First and foremost, what is your estimate? The fact that these runoff factors, these runoff rates are a lot lower on wholesale deposits as well as these mobile and internet retail deposits, a lot lower than what was earlier being proposed. To what extent does it help?
See, I think RBI had themselves given that it will lead to a 6% increase in the LCR for the sector. So overall, I think the answer is clear. That's a positive development. The changes there are three key changes. I think the first is a reduction in the runoff factors for wholesale deposits. I think this is the biggest positive, and this will benefit banks which have a more granular wholesale deposits, right? So I'm talking about the deposits from trusts, partnerships, HUFs. I think some of the large private sector banks and some of the larger public sector banks have a greater share of these deposits, so they might stand to benefit a bit more. The other two changes are net negative. One is an increase in the runoff factor for retail deposits. It's lower than what was expected, 2.5% runoff versus 5%, but still a negative for banks with high share of retail deposits. So someone like a federal bank, for example, will see a greater impact from this particular change compared to the others. The third is a reduction in the HQLA numbers because of a haircut. But put all of these three together, I think it's still a net positive for most of the banks. And this is in addition to a series of steps that RBI seems to have taken to ensure that growth is revived, or at least there's no further slippage in growth across the sector and the broader economy.
Pranav, that's on LCR, and I mean, that I think was the only one regulatory overhang or the small niggle, and that's also very clearly been done away with now. But overall, if you're looking at the results also that are coming in, it's absolutely fabulous blue skies, right? You can't complain. There's decent growth. Margins have not fallen as much. Asset quality seems stable. Growth in many cases, even deposit growth is beating very subdued estimates. I mean, I'm talking about the recent numbers, HDFC Bank, ICICI Bank, etc. So how are you placed on large banks, and how much of this optimism, how much of this, these good numbers are already in the price?
Not a lot. Okay, we are bullish on the overall large private sector banks pack, right? I think they are well set up and with average valuation, maybe even below average valuations, but clearly above average profitability and growth. So the setup is good for the large private sector banks, and we're bullish on that whole pack. Now, the numbers wise, I think while profitability has been great, I think growth has seen a significant slip from the peaks we saw about 12 to 18 months ago, which is what I think the RBI is trying to fix with all of these measures. So if all these measures result in a pickup in growth, so I'm talking about the private sector banks as a whole, getting back to 16-18% year-on-year growth, I think that will lead to a reasonable re-rating for these stocks. Because today they trade at a significant discount to their long-term multiples, simply because the growth is not as stellar as it used to be, or relative to their public sector peers, the gap is a lot narrower now versus where it was in the last decade.
Pranav, hi, good morning. Prashant here. I think dark horse, not dark horse, you liked IndusInd Bank, Pranav, right?
Yes.
The last time we spoke. Yeah. Yes. It's up 20% in, four sessions now. 15 last week and 4-5% yesterday. Best performing, bank. Of course, here the issues were much deeper, and there's the broader tailwind, but also, I guess, valuations got very attractive, as you pointed out. So good to kind of sort of spot that. What now on IndusInd in terms of valuations, etc., and also give us a sense of valuations overall.
Okay. See, I think let's talk about IndusInd first. I think IndusInd right now is, I think the valuation as well as the stock performance will probably be determined by what happens at the management level. I think from a numbers perspective, with the MFI issues largely done for the sector and set for a recovery maybe in the first or second quarter of this year, I think from an operating metrics perspective, the concerns are much less. I think the big catalyst for the stock remains the management change. They have a deadline, 1-year deadline for the existing management, and the change has to be recommended to RBI a lot earlier. So getting a credible private sector candidate and more importantly, RBI approving that candidate, I think will be the big catalyst and big reassurance for investors. I think that's the big catalyst to watch out for. And what makes it still attractive from a risk-reward perspective is the cheap valuation. I think for the numbers that IndusInd has generated in the past or can generate going forward, the valuations are cheap because of this overhang on the management. With that getting settled, we should see a reasonable up move on the stock. On the valuations for the overall sector, we think despite the run-up in the last few weeks, the valuations for the sector is still in line with the long-term average, with the private sector banks still trading at below average valuation multiples. So as a pack, if you take the top 4 banks, I think on a price-to-book basis, they're still lower than the long-term average. So a reasonable upside remains, apart from the healthy compounding that they can deliver. So still quite attractive from the large 4 private sector banks perspective.
Okay, so large 4 private sector banks still looking good. And since we have you with us, what about NBFCs? I think, Bajaj Finance, SBI Card, these are some of the stocks that you have on your radar. What's the story here?
I think NBFCs have seen a nice rally in the year so far, thanks to increasing expectations for rate cuts increasing, or the quantum of rate cuts are increasing. I think that's led to the nice rally, plus the reduction of concerns on asset quality. I think those 2 factors helped drive the nice rally. And then you also had some growth stimulus in the form of tax cuts, which is expected to drive growth back up for some of these names. Now, our concern on the NBFC stocks is more on the valuation. We think most of the good news is priced in. And if we were to assume even sharper rate cuts to justify the valuation, concern is that those rate cuts will come only if the growth is getting softer, right? So it's unlikely that you will see a return back to 30-40% growth levels, and RBI continues to cut rates at an aggressive pace. Both might not happen together. So if only one of the 2 happens, then maybe the valuations seem a bit of a stretch at this point.
Okay, all right. Pranav, appreciate you joining us. Interesting thoughts there. Thank you very much for the perspective. You have a good day. That's the view coming in on financials from Bernstein. They still like a lot of the large banking names, saying there's still some value left on the table.